Hi there, this is Mike Kramer of Ma Capital. Today is Tuesday, August 13th. It's around 4:30 New York time. Tomorrow we're going to be getting the CPI report here in the U.S. There's been obviously a lot of attention to these numbers in the past, so this will be another big report. May and June showed some meaningful disinflation, and so everyone's going to be looking at the July numbers to see if that trend continued. And so we're only looking for a 0.2% increase on the month over month numbers, and we're looking for a 0.2% reading on the core numbers month over month, both up from where we were in June. Year over year, we're looking for 3% flat with last month, and 3.2% year over year on the core, down a tenth from last month. And then on Thursday, we're going to be getting retail sales, and everyone's been paying close attention to this initial jobless claim number. Last week, the number came in a little bit lighter, and that resulted in the markets jumping. So this is a number that we'll probably want to pay some close attention to. Then we'll be getting some more import-export price data on Thursday morning. Then finally on Friday, we're going to be getting University of Michigan preliminary numbers. So lots of data to come here in the U.S. And the data overall obviously has been playing very important roles in really shaping what's happening in the market, specifically in rates and the FX market. And, everything seemed to stem with and started with the yen trade. We obviously saw a very sharp move down in a lot of the currency pairs, with the yen meaning strengthening. Now today, as we go into these reports, this data is going to play a crucial role, because what's really been driving a lot of the movements we've been seeing in the yen, it would seem, is really these interest rate differentials that are taking place between U.S. and Japanese 10 years. When you just overlay a chart with the U.S. 10 and the Japanese 10, and then you overlay the yen, you can see it's almost identical with the slight divergence that took place right here in this period of time, but they seem to have now caught back up to one another. So this is pretty important, it would seem, because if we were to get weaker data here in the U.S. over the next couple of days, and we were to see 10-year rates moving down, or 2-year rates for that matter moving down, and interest rate differentials were to continue to contract, one would think that the yen would probably start moving lower again. And when we look at the yen right now, and we look at where it is, it's at a sort of an interesting inflection point, because you can see I have this line drawn here. We tested this area now 4 different occasions, and 4 different occasions this region held. This is at the 147.90 level, and we could just round it to 148 for argument's sake. And that's obviously been the level where the buyers of the yen, sellers of dollars, have stepped in, and this has been an important level. So if we were to get weaker data over the next day or two that were to result in the yen weakening above 148, it probably would suggest we move up to around 149. Maybe we even get back into the 150 area. But when you look at the pattern I have drawn out here, you can make a case that this was a symmetrical triangle forming, and this broke, and that's going down now. You can also make a case that maybe there's a megaphone, a broadening wedge pattern that formed, and that also broke. So again, you have 4 failed attempts at this same level. It looks like we have some support in this area around 146.25. A break of 146.25, I think, sets up a potential retest of this low at around 142. When we look at the euro versus the yen, a very similar look, where we clearly have this area of resistance right around this 161.5 to 162 region. You could certainly make an argument that there's a slight uptrend in the yen at this point, and we're contracting. So again, I largely think that these currencies are all going to be trading together for the most part. And if you were to see the USD JPY move down, I would expect the euro yen also to move down. When we look at the euro versus the dollar, that's been moving and strengthening more recently, again, because the U.S. data has been a little bit weaker, and that's kind of expected. And really, we can see the euro broke out and over a major level of resistance today at this 109.5 level. It seems to be setting up finally a potential retest of this area in here around 111. We basically have been saying that had been range bound now for a really long time, really almost 8 or 9 months. And so this is a pretty significant breakout to the upside. We're not really even overbought yet, so there's certainly more room for the euro to continue to extend. You can see on the RSI, on the Bollinger Band, we're just at the upper end of it. But again, what this is sort of implying to me is that weak data here in the U.S. probably means the euro goes higher versus the dollar, and so retail sales and CPI will be very, very important for that tomorrow and the rest of this week. When we look at the pound, this has been also a confusing currency to deal with more recently. We've been going back and forth with directions on it. It had looked like it had, finally broken out. We came back down. We tested the 128 area. Then we came down and we even tested further at 127. Now we're moving back up above 128. This is a confusing spot for the pound to really be in, because are we merely retesting the broken trend line and then going to go back this way down, or are we is this really just the start of a bigger up move and potential move back up towards this 133, 132, 133 area? Again, I think it goes back to what this data is going to be, because if the data is weak and it continues to show the U.S. economy is showing signs of slowing, then you're going to continue to see the pound strengthen versus the dollar and continue to move up. If the data shows for some reason you get a hotter than expected CPI report or really strong retail sales numbers, then you're going to really see this pound move down and potentially move back to this 125.5 level. So playing the data right now is really the most critical thing, I think, and having a good understanding of what it means and what it implies is probably even more important. Copper prices have also been very volatile. It looked like maybe last week they were starting to break down. We were testing the support area around 4. So far, support around 4 has held. Again, we're not nearly as oversold as we were. There is still clearly a downtrend in the RSI for copper. And so, again, I would continue to think that if data in the U.S. continues to be weaker, we continue to see copper potentially move down to around this 385 level. Again, if there's signs of inflation starting to heat up, and we start seeing signs that the global economy is starting to do well and the U.S. economy is expanding, then you could see copper begin to move back up to 445. But the data more recently has been on the weaker side of things, and so that's partially why you're seeing this move down in copper. Last week when we were looking at gold, we were talking about it being pretty much in this range. Potentially even, sort of this megaphone pattern that had formed. We were thinking maybe it could come back down and test this lower bound around 2,300. Gold had a different idea in mind, and instead gold has moved back up and moved back to the highs at around 2,500 or so. And so this is another critical area, because this is now the third time that gold has tested this region. You do have a neckline at 2370, so you're going to want to watch to see. I mean, really, it becomes a fairly easy setup for gold, because if indeed this is a real breakout and gold actually extends higher, then there's nothing to say that gold couldn't run another $100 or $200. But again, if this is a false move, then gold could potentially fall all the way back down to this 2370 level, and from there we'll just have to kind of assess it, because a break of 2370 obviously then sets up a move to 2285 and potentially something further. I mean, gold for the most part has really just been consolidating in this region, and a lot of this comes despite the dollar really breaking down and looking really weak on the DXY. And so you would have thought at this point gold, if it was going to make a significant move higher, it would have already done it. So this is sort of a tricky region for gold, and we just need to see, I think, what it wants to do in terms of having it tell us what it wants to do. We've seen the DAX bounce back a little bit. Clearly the RSI did come down to around a 31, or came down to about 30 and managed to bounce. The DAX hasn't really rebounded quite as much as the U.S. markets have, but what we're looking at here is still trying to recover from the losses we suffered on the week of August 1st. And with that, we filled completely one gap. There's still one more gap to fill here at around 18,100. If U.S. markets are any indication, then we should be seeing the DAX continue to lift. But what's sort of, interesting is that at least at this point, the DAX broke two really important levels of support. It could be significant. And until we get really more information in terms of what's happening with other markets globally, it would seem to me that the upside is fairly limited, I think, to maybe around 18,050 or so, filling the second gap, which would really allow it to kind of follow what we've been seeing in the U.S. markets, in the S&P, for example, because that did just about fill a gap here from August 1st, and the NASDAQ has also just about filled a gap from August 1st. So this is what I'm saying, like the DAX has really just underperformed relative to some of these other markets, and it's really a signal more of weakness than it is of anything else. The FTSE has also rebounded. We came down and we tested this area of support around 78.90. This point is held. You can see we're making a nice rebound. Again, I would be probably looking for resistance in this 8,290 level. And right now the momentum looks like it could potentially carry that far. As we just touched on, the NASDAQ did just basically refill the gap. Again, the other interesting piece here is that we have this trend line, and you can see that we broke below the trend line by gapping through it last week. Now all we've done is basically come back and touched it. The big question is whether or not the NASDAQ is going to continue to move through that trend line, or whether the NASDAQ is going to fail. And it's interesting that we get to this point in time ahead of big data points that are coming. And when we also look at the NASDAQ, you can see we basically got up to the 20-day moving average, and that's where we stalled. So at this point, you really can't look at the NASDAQ and say this is nothing more than just a bounce off of very oversold conditions, and we're just retesting two really key important levels at the 20-day moving average and this trend line, which, by the way, not only was support in these two regions, but really served as support as recently as July 30th and August 1st. So this is a really, really important level. Clearly, a break of this level probably results in the gap filling at 19,800. If we were to fail here, I would look for new lows in the NASDAQ. I think that this would be a very negative indication if we were to fail at this 19,000, or if we were to fail at this 19,000 level. On the SPX, it's not exactly the same story, but we do see that the SPX also came back up to its 20-day moving average today, and that is also an important level of resistance. The NASDAQ, the S&P also came back up and basically refilled the gap at 54.35. Again, this looks like a market that's just coming off of very oversold conditions, and it looks more like a retrace at this point. What's interesting, I guess, when you look at the S&P is that it's really hasn't even gotten to the point yet where it's a 61.8% retracement. So it's not really clear whether or not this is the meaningful anything, because again, if we start getting weaker data here in the U.S. and that starts causing these currencies to start really fluctuating again, that's going to really be a negative for the S&P, because for the most part, when you look at the trading in the S&P versus that of the yen, they follow each other pretty closely. over the last several months. And more importantly, because the yen has really stalled out in this region, it's given the S&P some ability to kind of deviate from that relationship a little bit. And so that's why I think the next couple of days here are going to be really important. The Dow has also bounced back. Again, here's your gap basically filled. Here's your 20-day moving average up a little bit higher. So the Dow at least hasn't really retraced quite as much as the S&P or the Nasdaq. There is still the potential for the Dow to rise to around 40,350 to fill this second gap that was created on August 1st and August 2nd. Again, the Dow, just like the others, very oversold on Monday, August 5th. And it looks like at this point we're just seeing a bit of a recovery. If you can get above this 39,720 area, I would be looking for the gap to fill at 40,350. Anyway, again, busy couple of days that are coming. It's going to create a lot of volatility, I think, in the markets. So I hope you found this helpful, and I'll see you next week. Bye.